Okay, so talking about the Sarbanes-Oxley Act of 2002. So after Enron, the fun was ruined for everybody. Okay, so I'm joking. Fraud is never funny, but neither is the CPA exam. So we got to know for this section all the primary elements of SOX 2002. So we're going to talk a lot about the responsibility of management and audit committees. We're also going to touch on all the different trouble that you could get into for breaking these rules. Okay, so now we're going to talk about something called Enterprise Risk Management, ERM. Okay, so this is the second framework that you need to understand well for the BEC exam. Specifically, this is talking about risk assessment. So this might ring familiar. Thinking back in the COSO internal controls framework, you might think immediately of that risk assessment component, right, within our 5 components of internal controls, that crime mnemonic. So this is similar to that component as it pertains to ERM. So per the COSO framework, enterprise risk management is defined as various cultures, capabilities, and practices to create, preserve, and realize value. Okay, so this is going to be putting forth a set of plans that are directly related to various organizational performances so that we can better implement strategy for mitigating risk as it pertains to the overall strategy of that business. So some of the reasons why enterprise risk management would come into play would consist of what? So we want to know, why would systems not work, right? Why does this risk even exist? Well, people might often make decisions based on personal experiences, which might not necessarily be based on facts or data. Okay, so we need to understand the overall importance of individual risk as well as the appropriate controls for each risk level. People might also use intuition or subjective opinions when making decisions, right? People are biased, so they're naturally going to do what aligns with their overall viewpoints and experiences. They might not always be factual, and that might lead us down the wrong path. And finally, people might also rely on insurance. Okay, so insurance policies might be a cause for an inflated risk. Okay, so the general rule is that there's 2 types of risk. We have negative risk and positive risk. So what does that even mean? What could positive risk possibly be? Well, we know that negative risk is pretty obvious, right? This is going to be something like a new accounting system failing and the company is unable to understand its various transactional information. Okay, so this can include the risk that something occurs in which we have no idea, right? How many sales we have for this period. We don't know how much inventory we have in stock, right? Everything's a mess. So what's the risk that something can negatively impact our business? Whereas positive risk is something that, although it is a problem, it could be a good problem to have. Okay, so a great example here is that the demand exceeds the supply of whatever it is that we're selling. Okay, so at the end of the day, we're selling inventory, we're selling services. We can't keep up with how much people want to buy our stuff, all right? So this is a good problem to have, but it is a risk nonetheless. Okay, so enterprise risk management is a framework that will allow management to better understand how to optimize risk, all right? So mitigating risk to the optimal level. So just like the COSO framework is a framework or a set of rules that allows management to implement the strongest possible system of internal controls, we're talking about a rule book here once again. Okay, so the COSO Enterprise Risk Management Framework will apply a risk-based approach as opposed to a control-based approach, right? The overall objective of the ERM framework is to attain and sustain reasonable assurance that the company's objectives and goals are being achieved, right? And that the company ultimately meets performance expectations. So at the end of the day, this is about understanding our risk appetite, right? So just like the COSO framework has various objectives, components, and principles, when talking about internal controls, we're also going to need to know about the various objectives, components, and principles as they pertain to ERM. Okay, so we're going to break out our 4 categories of objectives. Then we're going to break out our 5 main components of ERM. We're going to introduce what's called the CRISP mnemonic, and then we're going to break out all of our 20 major principles. Okay, so as we said, 4 categories of objectives, 5 components, and 20 principles within those components. Okay, so understanding the intuition for enterprise risk management is helpful, but at the end of the day, you still need to have this memorized all day long, all right? So that's going to be how you get the 75% that you need on this exam. Ultimately, this is going to be flashcard city, all right? We got to pull out some flashcards and we got to really memorize this stuff. Okay, so the exam just wants you to get these questions right. They unfortunately don't care about how you're going to apply this to the future good of mankind. So we want to do this with a ton of reps and ultimately apply this in practice when we see these multiple choice questions, right? So 4 major categories we're going to talk about. We have pretty much the same objectives as we talked about for the COSO internal control framework. The only key difference here is going to be the strategic, right? This S at the end of ROCs. We still have reporting, operations, and compliance objectives, right? So reporting is going to be just ensuring that reliable reporting to the public exists. Operations will be effective and efficient use of the entity's resources. We want to have the objective of compliance, right? Complying with applicable laws and regulations. And strategic just is talking about having high-level goals that align with the support and the mission of that entity. Okay, so although every single ERM framework has these core 4 objectives, they will still have limitations, right? There's never going to be a perfect ERM model. So these limitations are going to ultimately have additional risks that come with them, all right? So limitations for ERM you should be aware of are going to consist of human judgment and human error, cost-benefit analysis, right? The cost versus benefit limitations, errors made by management, collusion, right? Two departments colluding with one another, and management simply overriding control. Okay, so now we're going to apply our 5 main components just like we did when we talked about the COSO internal control framework, right? So we're going to now introduce what's referred to as the CRISP mnemonic. Okay, so each of these elements are going to be a reflection of the 5 main components of internal controls. We're going to talk about governance and culture. Okay, so the C is going to stand for culture. Review and revision is going to be our R. I is going to be for information and communication. S for strategy and objective setting, and P for performance. Okay, so within each of these 5 components, we're going to collectively have 20 total principles that we need to understand. Okay, so yes, it is important that you know that these are the 5 components, but you more importantly need to be able to see a question, identify what it is they're asking, and back in that principle to the correct answer choice, right? So that's ultimately what they're going to ask when it comes to understanding ERM. Okay, so let's dig right into this. Okay, so now we're going to talk about the 5 major components of enterprise risk management, all right? So we talked about the 5 components for the internal control framework under COSO. We're now talking about the 5 ERM components that they have of their own, all right? So we're going to talk about governance and culture. We're going to talk about information, communication, and reporting, right? How we communicate that risk to ensure that everybody's aware of where risk lies. Strategy and objective setting. We're going to talk about performance, right? What are we doing? Are we improving? Are we regressing? This is what we're going to be assessing. And finally, review and revision, all right? What type of issues can come up? Are we making adjustments based on that review? So those are going to be the things that we talk about as we're breaking out our 5 major components of ERM. Okay, and the first component that we're going to talk about is governance and culture. And we have 5 principles that fall within this component. Okay, so exercise board risk oversight. So the board of directors is going to provide oversight of the strategy and carry out governance responsibilities to support management in achieving strategy and business objectives. Okay, so this is the primary objective and the role of the board, right? To provide oversight and ensure that specific cultures that we are looking to sustain exist. Establishes operating structures. Okay, so the organization needs to establish operating structures in the pursuit of strategy and business objectives, right? Is there a hierarchy that is coming into play? Okay, so just so we can achieve what those business objectives are. Defines desired culture, all right? So the organization defines the desired behavior that characterizes the entity's desired culture, right? Will culture have an impact? If it does, what culture are we going to be offering here? Is this going to be a totalitarian dictatorship, or are we offering a culture of community and collaborative efforts? Okay, so at the end of the day, the definition of desired culture should be the third element. Demonstrates commitment to core values. Okay, so the organization must demonstrate a commitment to the entity's core values. So this can also be thought of as the equivalent to tone at the top in the COSO internal control framework. So this is basically just a broader view of core values and how the company is projecting the structure of their core values, right? Attracts, develops, and retains capable individuals. So the organization is committed to building human capital in alignment with the strategy and business objectives. Okay, so this is essentially the equivalent of commitment to competence, right? We're making sure that we are committed to building out the ideal team, that human capital network, all right, and ultimately finding that sustained success. Okay, so next up we have review and revision. So by reviewing entity performance, an organization can consider how well the enterprise risk management components are functioning over time, all right? So in light of any substantial changes. And what we ultimately want to understand is if revisions need to be made. Okay, so there are 3 principles that relate to review and revision. They're going to consist of assessment of substantial change first and foremost. Okay, so this is going to be when the organization identifies and assesses changes that need to be made based on substantial effects to the strategy and business objectives. Okay, so we want to assess any sort of changes made to the company, right? If there are significant changes in upper level management that can impose a new risk that the organization is not going to operate as it used to, that could be a problem. Okay, so that's considered an internal risk. It can also be an external risk, right? So just like MySpace was completely vaporized by Facebook in the middle of the first decade in the 2000s, right? I think it was around 2004. Okay, so a neat little startup called Facebook came out of a Harvard dorm that basically changed the entire digital world as we know it. Okay, so various external reasons can have an impact on substantial change to the company. Got to make sure that they are being assessed and properly responded to. Review risk and performance. Okay, so the organization reviews entity performance and considers the overall risk. So the overall review of risk and performance understanding is going to be the overall performance after the risk was assumed. Okay, so very commonly, this is going to be seen amongst traders, right? Those are going to be those who are trading derivative transactions, etc. So we want to understand, okay, based on this hedge transaction, what was the overall performance? Did the reward outweigh the risk? And that's all we're going to be looking for, all right? So a little bit of a subsequent cost-benefit analysis. Pursues improvement in enterprise risk management. So the organization pursues an improvement to the overall enterprise risk management system. How are we going to improve this? We've just conducted our final review and the overall performance after decisions have been made. Look, do we improve this going forward into the future, or are we staying pat? Okay, so that's the ultimate question at hand. Next, we're going to talk about information, communication, and reporting. This is very similar to what we talked about in the COSO internal controls framework. Okay, so enterprise risk management is also going to require this continual process of obtaining and sharing necessary information from both internal and external sources, right? So that's going to go up and down all across the organization. So the organization is going to be in search of constantly capturing, processing, managing, and communicating both timely and relevant information to identify risk that could affect strategy and business objectives. So there's going to be three principles that relate to information, communication, and reporting. Leverages information systems, right? So the organization leverages the entity's information and technology systems to support ERM. Okay, so as we are making sure that we are leveraging information, we're going to also make sure that we're distributing relevant information as well. Okay, so we can use this to interpret if we're properly correct information that we have absorbed, and we're going to use it to make necessary change to overall improve the company's efficiencies and operations, right? So technology is being applied in just about every area in today's business world. We need to understand how data is being managed, right? How is data being absorbed in an information system? How's it being manipulated, optimized for future improvements to the company? Okay, we want to understand how we're communicating risk information, right? So the organization uses communication channels to support enterprise risk management. So this communication risk is either going to be internal or external, all right? So anywhere from stakeholders in the company to the board of directors, all right? And the ultimate overall communication of risk should consistently be monitored and evaluated to ensure that the most effectiveness is coming out of it. And finally, we have reports on risk, culture, and performance. So the organization reports on risk, culture, and performance at multiple levels of the entire entity, all right? So at the end of the day, we want to know how do we perform when it comes to managing risk, okay? So we're going to be looking at this at the entity-wide level as well as various segments of the company. And that can include various business units, major reporting areas. Okay, so at the end of the day, we're breaking out our overall reports on risk to both of these levels. So the second element is going to be strategy and objective setting, all right? So we have analyzed business context, and this is saying that the organization considers potential effects of business context on risk profile, okay? So companies are going to generally operate in external and internal environments, so we want to know the risks that lie within the specific business context, right? Those risks could prevent us from achieving what it is we're ultimately looking to accomplish, right? It must define risk appetite. So the organization defines risk appetite in the context of creating, preserving, and realizing value. So what we need to do is define risk appetite. What is risk appetite really? How much risk are you willing to take on? Okay, so depending on if we have a low or high risk appetite, management is ultimately going to dictate how companies are going to manage that specific risk. Evaluating alternative strategies. Okay, so the organization evaluates alternative strategies and potential impact on risk profile. All right, so understanding what alternatives might be in place, all right? What's the overall impact on risk? Formulates business objectives. The organization should consider risk while establishing the business objectives at various levels that align and support strategy, okay? So what are the overall risks? And what are our overall goals that are associated with those business objectives? Okay, so now we're going to talk about the overall performance. Okay, so performance is going to indicate that risks have an impact to the overall achievement of strategy and business objectives, which need to be identified and assessed, right? So risks are going to be prioritized based on severity in the context of risk appetite. Okay, so we want to know what type of risk are we dealing with here? Are we dealing with risks that we're not going to be profitable this year? Are we dealing with the risk that the Fed is going to increase interest rates, right? That's going to prevent us from borrowing money. Okay, so first and foremost, we need to identify what type of risk we are dealing with, and that is ultimately the first element of performance, right? So identifies risk is just saying that the organization identifies risk that impacts the performance of strategy and business objectives. After that, we've identified it. Now we can say that we are going to assess the overall severity of that risk, right? We want to know which risk will cause greater threats. Okay, so important to understand what is the overall severity of the risk that we're dealing with. So after we've assessed the overall risk and the respective severities, we're going to then prioritize which risk we want to respond to. Okay, so this is essentially going to consist of a hierarchy of risk, which is ultimately going to be the overall threats that need to be prioritized, right? So now we got to respond to that risk, right? So we're going to implement risk responses to the organization, which will ultimately be identified and selected from various options. Okay, so once we have identified a risk, the four options that management will have will be to choose either to accept the risk, reduce the risk, share the risk, or avoid it altogether. Okay, so risk acceptance will be if the organization elects to assume all of the risk that has been identified. Risk reduction will be if the organization has implemented controls that mitigate the risk of a specific activity. What about risk sharing? So if the organization shares the risk with another organization, they can offset some of it by allowing somebody else to assume some of that risk. Risk avoidance, if the organization elects to not engage in the activity whatsoever, right? They're running away from this risk. Okay, so those are the 4 solutions that you should be able to identify when it comes to responding to risk.